that investment returns yearbook, I think, is a fantastic publication. They originally did it in 2000 for the 100 years from 1900 to 2000, and then they've been putting it out every year ever since. So we've now got 120 years of data of all those markets that had, that have been going since 1900. So it is, to me, it's a fascinating report and fantastic data. And as you rightly point out, what it did show was that the Australian market has been the best performing market in the world over the long term. So in nominal terms, Australia's delivered about 12% per year for 120 years, which is just a phenomenal achievement. Now, but that's one thing. The really interesting thing is, well, why has Australia done so well? Which comes to your point now, well, can it continue? And what they sort of highlighted was several key features of those markets that did really well. There was several sort of features that were consistent across the markets. And the first one was, a lot of them typically were New World countries. So basically countries where you had population growth. So the countries that did really well had population growth. The countries that did very poorly over the long run typically had population decline. And when you think about it, that makes sense. So since 1900, the Australian population has grown about 2% per year. Now that's about sort of 5 times OECD average. But that's that means the Australian market is a structurally growing market. We've got 2% new people every year. Some of it is from demographics, from new births, but a lot of it is, comes from immigration, and we are an immigrant country. But it means basically, before anything, we need 2% more houses, 2% more, goods and services. And that's a really strong underpinning to structural growth. Other markets have got population decline, and they're in a much tougher position. So that's the first point. Those that have population growth did really well. Those that didn't did poorly. Next one was just those countries that were lucky enough to have natural resource base. So, and probably more important than that, those that were lucky enough to have a low cost natural resource base. So, the tons mined in Australia has never really gone down all through time. And that's mainly because we are, in a lot of the products that we produce, we are the low cost producer. So as an example, in iron ore, the cost of production of iron ore is about $20 a ton. So now, iron ore went from 40 all the way up to 200, came back to 60. We're now back at a sort of 120. But when you're pulling it out of the ground at $20 a ton, we've got a huge incentive to expand production when the price is 120 or $200 a ton. Even when it's $40 a ton, we've still got, we're incentivized to expand production. Other countries where the cost of production is $100 a ton, they stop producing, which makes sense. So that's also why our tons mined in Australia have never really gone down. We've gone through a few flat periods, but never really gone down. And why it's not just the fact that we're natural resource rich. It's the fact that we've got those, and we're low cost. We're normally the world's low cost producer in those products as well. Third one was corporate governance. So one of the other things they looked at was they sort of tried to correlate GDP growth with stock market returns. And they actually found zero correlation between GDP growth and stock market returns, which is interesting at face value. But when you think about it, it sort of makes a lot of sense. So obviously those countries that have really good corporate governance, where rule of law matters, where individual property rights matters, then yes, it is linked to GDP, because then as much as you grow, if the shareholder is protected and has their rights protected, then the returns will do well. If you're in a high growth market, but your assets can be taken off you or the rules can be changed, that doesn't matter. How high you grow, how fast you grow is completely irrelevant, because you could get your asset taken off you, whatever the government decides to do. So corporate in Australia has one of the highest corporate governance environments in the world. So we have done well out of our good growth. But the interesting thing is they found that the best correlation of stock market returns right around the world is the dividend yield of that market plus the real growth in dividends. Now, so once again, that sort of makes sense when you think about it for the long term. So in the long term, as equity holders, we earn our economic rent from the dividends we receive and the growth in those dividends. And Australia has one of the highest dividend yield markets in the world, and we've had one of the highest real growth in dividends as well. Now, we're at a high dividend yield basically because of franking credits. So if you look at or the imputation system, so Australia has a payout ratio of around about 2/3. So about 65% is our payout ratio. If you look at the US, it's probably closer to 20%. Once again, it makes sense. So investors like me say to companies, well, we want as much of the dividend of your profits as possible in dividends, because and the frank imputation system was set up so that taxation is only paid once. So once the corporate pays the tax, it then comes back, and the credit is linked to it is the 30% corporate tax rate. Whereas in the US, you know, why would you pay a dividend? Because you got to pay tax twice on the same profits. You got to pay it at a corporate level. Then when it gets distributed, they got to pay tax as well. So it makes sense that they wouldn't have a high dividend payout ratio. But the really interesting thing that creates is probably an unintended consequence. But and so the high dividend, a logical, what a sort of logical argument is that if you've got a high dividend payout ratio, that should mean low growth, and a low dividend payout ratio should mean high growth. Now that's sort of logical in a sense that if you're keeping all the profits and you're reinvesting in your business, you'll grow stronger. But that's not actually what academic research found. Academic research found that higher group of dividend payout ratio firms or countries outgrew the low dividend payout ratio firms and countries, and they put it down to capital discipline. So when you're paying out, say you've got a payout ratio of 70%, so you're retaining 30% to invest in your business. Basically, you've only got 30% to reinvest. So you're very careful with the money. You want to make sure you earn your required, return on invested capital. So for companies that had a 70% payout ratio, that 30% got reinvested and they were earning 15% return on invested capital. For firms that had paid out no dividend or a very low dividend, that money was burning a hole in their pocket. They had no discipline about acquisitions. They were spending money, as quickly as they could. They were making empire-building acquisitions and, wasting the money. So when you had a zero dividend, when there was a zero dividend payout ratio, that profit, the return that you got on that was 3% return on invested capital. So even though it was less being retained for the business, it was a much higher return, and those companies were outgrowing the ones that didn't pay out a dividend because they were wasting the money and they were getting a very low return on invested capital. So what you ended up with, because of a high dividend payout ratio, you actually ended up with a high dividend yield and then high real dividend growth, which made Australia, that's the key reason why Australia's been the best performing market in the world long term. I think the other thing people sometimes forget when you look at Australia versus Asia or versus other parts of the world, someone once described Australia as a workhorse, not a racehorse. And I thought that's a really good description, because we are. I mean, Australia sort of does it. When you look at the long term, we sort of do our 10 to 15% every year. We tend to very rarely do 50%. That's not what we're about. We're about 10 to 15. Some Asian markets will go up 50, 100, 200 in a year, and they're more the racehorses, but they'll do that. But then the next year they'll be minus 20 or minus 50, or they're much more volatile. Australia tends to do its 10 to 15% most years, which puts it in the top half each year. But when you add that up over 20, 30, 40, 50, 100 years, and you can keep there, that makes us the best performing in the world over the long term. So, the lesson over the long term, it's the workhorse that delivers, not necessarily the racehorse.
And interestingly, I think of those factors that you've talked about, many of them remain in place. The low-cost resource producers, the dividend system obviously is still in place. And whilst population growth may be temporarily impacted by immigration falling off a cliff around COVID, you'd expect that over time that would normalise to a certain extent if you look through it.
Exactly. And the immigration one, which is the one, I guess, that's changed a lot under COVID, you know, I'd probably argue that if anything, you know, Australia is one of the countries in the world that has handled COVID-19 probably better than most countries. Our institutions have held up. And I think that's another important part of not just corporate governance, but strengthened institutions. And Australia is well positioned there. Our institutions have held up well. You know, we've gone through COVID, you know, in much better than most parts of the world. So I just think when we start to normalise, the demand for education in Australia, students coming back to Australia, that's going to increase. It's not going to decrease. Demand for people coming to work here, that's going to increase, not going to decrease. And people who want to move to Australia, that's going to increase. So I just think Australia will be seen. I mean, we're always seen as an attractive place to work, study, and live. But post-COVID, given the way we as a country have handled it, I think that demand will only increase, not, you know, and that if anything, that will, you know, we'll see our population continue to steadily grow.